Great to see everyone. This is important. Another important video in this series that we like to do, where we try to share with business leaders, experts on all things critical to businesses here at the Central York Chamber. We open this up to non-members as well because it's really critical that businesses have an understanding of the economy, what's coming down the pike, and as much as it's impossible to fully predict, there are lots of things that with understanding of various trends and metrics, that we can have a best idea of some things that might be occurring. And so with that, we were very fortunate to have a relationship with BDC, who are here to present to us today, and I'll introduce actually, no, before I do that, I'll want to note, if people have questions, and Arnaud here has agreed to answer questions, please save them to the end, or jot them in the chat, and then we'll deal with them at the end. I'll be moderating kind of a Q&A at the end, because surely you might have some questions that arise, and we'll do our best to make sure everyone's questions get answered. But without further ado, I'm going to introduce Rishi Sharma, who wears two hats here. One, he works with the BDC and is a great partner of the Chamber of Commerce, but as well sits on our board of directors. So Rishi, welcome, and thank you for helping set this up.
Thank you, Chris, and welcome everyone. First of all, I just wanted to say it takes a lot, after this weekend, what we have seen, and to show up here. So again, I just would like to, I'm sure, Chris, we see your arms coming back, so you're recovering from that, legacy of things. But once again, thank you again for joining us today, and hope everyone had a good and relaxing family long weekend as well. So my name is Rishi Sharma, and as Chris mentioned, I sit in the board of Central York Chamber of Commerce as well. So, and I'm a senior commercial relationship manager at BDC, Business Development Bank of Canada. As you may or may not know this, but BDC has been dedicated to supporting small and medium enterprises across the country for over 80 years. As a Crown corporation, our mission is to help create and develop strong economic and Canadian businesses through financing and advisory services solution at every stage of the businesses. With our association with Central York Chamber of Commerce, we are ensuring that BDC creates strong partnership and with the local businesses to help them thrive and prosper. And basically, our presence also makes the difference in the community. Now, I always say and refer it back on a quick note, because during these uncertain times of trade wars, whatever we've been hearing, where even the news travel even faster than the speed of sound, it's a lot to digest. Therefore, we can only control what we can control, but I sometimes refer to a metaphor which says our mirror and window approach. So in terms of, as being entrepreneurs, where sometimes we have to look into the mirror and do a self-reflection of our current state, but not only that, but also seeing into the windows of the approach that allows us to seize the opportunities, like to be more customer focused and driven, and helps us giving us the balanced perspective. On the same note, it's my pleasure to introduce our distinguished speaker today, Mr. Arnaud Franco, and appointed as a Director of Economic Research at BDC, where Mr. Franco leads a team of brilliant economists dedicated to providing real and actionable insights to Canadian small and medium enterprises. He has nearly 20 years of analytical experience and a decade of management and leadership training, and also a seasoned public speaker, and have presented at numerous global conferences. So please join me in welcoming Mr. Arnaud Franco. Over to you, Arnaud. Thank you.
Thank you very much, Rishi, and thank you, Chris, for the invitation. It's a pleasure to be here today with you. Obviously, here at BDC, it really is our role to keep entrepreneurs informed as much as possible about the situation, economically speaking, and even more so in periods of high uncertainty like the one that we live. And Rishi, I really like your metaphor because I think that it's important to understand that uncertainty paralyzes us in a way. It makes consumers unsure. It makes investors and business owners unsure if they should move forward with certain investments. But it is definitely not the time to stop acting. In fact, there are opportunities in uncertainty to look within your company and figure out what the gaps are and what you need to prioritize in order to best prepare yourself to weather this potential storm. So thank you very much for that, Rishi. I think it really sets the stage well for the presentation that I'm going to give today. So I'm going to share my screen. You guys should be seeing the presentation in full screen mode in just one moment. Can I get a confirmation? Yeah, Chris? All right, cool. So let's go. The title of the presentation is Growth Despite Everything. It's relatively hopeful, I would say, but it does come with certain caveats, okay? So what I'm going to present today is an economic outlook of Canada with some of these uncertainty factors built into it. Then we're going to spend a little bit of time talking about the situation in Ontario. And then finally, I'm going to conclude with just a couple of slides which more target what I alluded to earlier about how to get your business into good shape to weather this period of uncertainty. So let's start with the Canadian economy. Let's start with what's good on the bright side, okay? So on the bright side, the Canadian economy slowed, but did not fall into recession. So what I'm showing you here is real GDP. Gross domestic product. It's an indicator that you hear about all the time. It's pretty much the main indicator for judging the performance of global economies. But I think we should just take a step back, and I'm going to do a few of these during this meeting, where let's call it Econ 101. What is GDP? So GDP is the sum of all the production value in the Canadian economy, and it's comprised of 5 categories. So consumption, GDP equals, first of all, consumption, which is about 60% of GDP, followed by, in no particular order, investment spending, government spending, exports, and then to that we remove imports, because imports are value, dollar value that are going to another country in return for goods and services that then come into our country. So I think it's important to understand because the components of GDP have been moving in different directions over the last couple of years. So when you look at real GDP, it's a very good metric of the health of the economy. And you can see that for a number of years, we have been performing below the 2% potential threshold of Canada. But the economic slowdown that we experienced was really triggered by an increase in interest rates. And that is the gray box that you can see that says tightening monetary policy. So the Bank of Canada began increasing interest rates in early 2022. And the reason for this increase was to get inflation under control. Now, more on inflation in just a second. But for now, it's important to understand that GDP did slow, but you can see that through the latter half of 2024, it actually showed signs of improvement and taking closer and closer to that 2% window. And this is a good thing. In fact, this, among economists, is what's known as a soft landing. We had a period of above-trend economic growth, which was the knock-on effect of all of the stimulus that was pumped into our economy during COVID. And instead of following with a period of weak or even a recessionary period, we were followed by an under-trend period of growth, but there were no mass layoffs in general. Consumers continued to consume. So all things considered, the Canadian economy has done quite well. And as I mentioned before, this slowdown in the economy was very much self-imposed. And the reason for this is that we needed the Canadian economy to slow down so that inflation could get under control. So as you can see from this chart, this is the CPI. It's the headline indicator for price growth in Canada. And you can see, I want to draw your attention to the beginning of 2020. When COVID hit, everything froze. Everything dried up. People stopped spending. Uncertainty was through the roof. We didn't know how long this was going to last, where it was going to go, et cetera, et cetera. But then governments reacted very quickly. They started putting in a significant amount of money into the economy in order to support those households and businesses who were under pressure from COVID, and there were many. So what these households did is because they couldn't go outside, they couldn't go on vacation or restaurants to shows, they started buying stuff. And they bought a lot of this stuff that came from overseas. Now, in addition to this stimulus offered by governments across the world, they also cut the interest rate to its lowest possible level to encourage people to borrow in order to fuel their consumption. And that's exactly what they did. They bought homes, they bought cars, they bought appliances, things that could be financed, were at very, very good conditions. So here's my second Econ 101 capsule, is that in economics, we have a basic theory, supply and demand. The price of a good is determined by the intersection between the demand for it and its supply. And what happened in this late 2020, early 2021 period was that demand for certain products increased a lot, but the supply of those products didn't adjust because there were no new factories being built. There were no new investments coming online, but there was more demand for these goods. So the natural equilibrium means that prices go up. And that's exactly what happened. We saw inflation start to become a real problem by mid of 2022. And the Bank of Canada took notice in March of 2022. They increased their policy rate quite dramatically. And we underwent a successive series of interest rate hikes, bringing the interest rate to about 4.5% in 2022. And it was followed by further rates, which brought it into 5% in 2023. Now, this interest rate hikes had an immediate effect on inflation. So you can see that after peaking in June of 2022, inflation turned the corner and started going down. And in fact, 6 months later, it was dropping very, very rapidly. And this is a very good thing, because having inflation under control is actually the Bank of Canada's #1 mandate. They want to ensure price stability for Canadian households. And to them, price stability is an inflation rate of between 1% to 3%. And you can see that post these interest rate hikes, we rapidly got close to that area. In 2023, we hadn't made sufficient progress, but in early of 2024, we started hitting that below 3% range that the Bank of Canada was looking at. And in fact, every month of inflation in 2024 was within that acceptable threshold. There will be a new inflation number coming out for January, live right now. I haven't had a chance to see it, but we don't expect any surprises. We think that inflation will probably be at 1.8%, consistent with what we've seen in December. So with this progress on inflation, it gave the Bank of Canada the confidence that it could now start cutting interest rates, and that's exactly what they did. So at the June meeting last year, they underwent their first interest rate cut in over 4 years, and they cut by 25 basis points. This was followed by two more successive 25 basis point cuts, and then 2 jumbo cuts, which we call 50 basis point cuts. So they're twice as much as the cuts that had been implemented up till now. So this was eventually followed in January of this year by another cut of 25 basis points. So as the economy has made progress on inflation, the Bank of Canada has felt comfortable lowering its interest rates in order to try to stimulate households and investments to get back out there and spend their money and invest, et cetera, et cetera. So how do interest rates affect our economy? Well, obviously there's an effect on businesses, and then there's effect on consumers. But before that, let's go with another Econ 101 and talk about what is exactly the policy rate. So the policy rate is a metric. It's an interest rate that the Bank of Canada sets, and it infers something we call the bank rate. The bank rate is generally 25 basis points above the policy rate. And the bank rate is the interest rate at which financial institutions can borrow money from the Bank of Canada. So every day, consumers, businesses transact, banks gain and lose money. And at the end of the day, they need to balance their books. So they can turn towards the Bank of Canada and take a loan at that bank rate, which right now is, I think, 3.25%, in order to balance their books. So when the policy rate goes down, the bank rate goes down, and so does the rate at which financial institutions can borrow from the Bank of Canada, which means that they themselves can offer cheaper credit to the market. So as interest rates come down, financial institutions adjust their own interest rate offerings in order to attract more of that investment from businesses. Now, it's been a tough road for investment in businesses, and we'll talk a little bit about that later on in the presentation. On the consumer side, So interest rates will impact any consumer that has a variable loan. So it could be on a car, on a mortgage primarily, on appliances, pretty much anything, line of credit, etc. So when interest rates go up, as they have between that 2022 to 2024 or mid-2024 period, it means that Canadian households are spending more of their money just to pay off the debt, just to service the debt. So it means that they have less money in their bank account at the end of the day for discretionary spending. So when this interest rate comes down, it means that consumers will feel a little bit less of the strain from those who have variable mortgages, and those who will be renewing their mortgages now will have better conditions than they had a number of years ago. So the interest rate coming down is a good thing for the Canadian economy. It's absolutely necessary. And we believe it's going to continue to come down, reaching about 2.5% by year end or mid-year. It remains to be seen. The uncertainty that we're experiencing in the market right now will certainly affect the policy decisions of the Bank of Canada. So should some of this uncertainty crystallize, we could see quicker rate cuts, and we could even see the interest rate, policy rate, falling to 2% by the end of the year, should the Canadian economy be judged to need a lot of extra invigoration from the crystallization of these uncertainty factors. So uncertainty, let's talk about it. A lot of this has grown in the Canadian economy over the last few months, excuse me. However, this might not be the first one that you think I talk about when we talk about uncertainty, but it is definitely non-negligible. So the Canadian economy experienced an extremely robust population growth in 2023 and 2024, posting the strongest year-over-year immigration gains in over 60 years, and the strongest of any developed country in over 60 years. And this is a good thing because the birth rates in Canada are among the lowest in the G7 countries. So we cannot rely on simply adding new people from Canada if we want to encourage more economic growth reaching our trend level. So the government let in a significant amount of people over the last couple of years, and it drove a good portion of the economic growth that we've seen. Now, the federal government announced late last year that they were going to cap their non-permanent resident entries in 2025 and 2026. And this will reduce in a significant fashion the population from that cohort, and could lead to a decline in population this year and next, albeit relatively small, but it would be the first time on record that Canada's population has fallen. And less people into Canada means less business owners and less consumers. So there definitely is a drag on the economic results that we expect. And in fact, it's one of the primary reasons why, as things stand now, we don't believe that Canada's GDP will grow at that 2% level. It's because for us to grow near potential, we need to have a steady source of immigration, and that will not be the case for this year and next. Now, on to the topic du jour, as we would say. Unless you've been living under a rock, I would say, you've probably heard of the tariffs that have been announced by the incoming, or the new, I should say, U.S. administration. So in late November, the president-elect mentioned that he would impose 25% tariffs on all goods coming into the US from Canada and Mexico, and a 10% tariff on all goods coming from China. It caused a certain amount of panic in the markets, but we didn't really know whether or not this would materialize. But an executive order was signed in January stating the intent to do this, and then some intense negotiations happened, leading to a delay in the decision to impose these tariffs, which will occur in early March. The tariffs that were announced were 25% on all goods and 10% on oil and energy. But those were not imposed, at least not yet. What were more concretely announced were a 25% tariff on Canadian aluminum and steel imports into the US, effective March 12th. I should say Mexico as well. In the case of China, the 10% tariff was imposed. So all goods going from China to the US are imposable by an additional 10% tariff on top of those that already exist. And that 25% aluminum and steel tariff was also extended to China. So obviously, this means that the steel and aluminum market will feel pressure because of these tariffs, because their US customers will now have to pay more for the goods that they're buying from Canada. And they buy a lot of raw materials and relatively unprocessed goods. So exporters will definitely feel some of that pressure. However, the importers, those who import steel and aluminum products from the US, especially finished products, they are also going to feel a lot of pressure, even without reciprocal tariffs announced. Because if the US customer is paying more for that steel and aluminum to then make their coiled roll of steel, the Canadian buyer is then going to have to pay more as well, because that price increase is then priced into the price of the good. So importers who source a lot of finished products from the US in the steel aluminum sector are particularly worried about the imposition of this tariff. Now, overall, the tariffs on aluminum and steel will have a relatively negligible impact on the Canadian economy overall. And I want to see negligible is a term that I weigh very, very carefully, because anyone who is in the aluminum and steel supply chain knows that it's going to affect them. So we don't want to make it sound like there will be no effect, but the effect on the total economy will be relatively negligible in terms of economic growth. Obviously, should the 25% sweeping tariffs be imposed, then all bets are off. We have to change our economic forecast, because then obviously things become very different. And it depends also how the Canadian government reacts to the imposition of those sweeping tariffs. Right now, it's very uncertain. We do not know if it's just posturing by the US administration or if there is a real willingness to go that deep on tariff impositions. So what do we expect over the next 12 months? Okay. Let's start with some good news. The good news is that household spending has improved consistently throughout the last 3 years. This is the driving force behind the Canadian GDP. This is the consumption portion of Canadian GDP that I was mentioning earlier. So through the third quarter of 2024, consumption was growing. It was doing well. And in fact, our surveys show us that intentions of consuming were rising significantly in the fourth quarter of 2024. So we think that consumption in Q4 will also be similarly strong. And advanced indicators of consumption in January are showing us that things should be relatively good. So this tells us that Canadian households, despite the uncertainty that kicked in late November, in December, and into early January, were still advancing their plans to spend more money. Of course, this was before the concrete imposition or signing of that executive order, which would give the US that ability to impose tariffs. So that will likely be a point at which consumers will start reconsidering their plans, and businesses as well, I must say. Supporting the consumption are the fact that disposable income has continued to rise very well in Canada over the last years. In fact, wage growth outpaced inflation over the last 2 years, which means that Canadian households, on an inflation-adjusted basis, have more money in their pockets at the end of the day and more money for discretionary spending, even if they are spending a little bit more to service their debt. The other good point is that savings in Canadian households are actually quite high. People have started building up savings in 2024 in anticipation of some of the instability coming on. And as interest rates come down, this should continue to keep Canadian households in good standing and consuming. One of the very important indicators that we're going to watch this year is the residential market. Obviously, it's very important for the Canadian economy and a market that's seen a good amount of stagnation over the last couple of years. We've seen home sales so far in 2024 pick up by nearly 8%. And this is very, very good, because for better or for worse, all of these new entrants into Canada, these people coming from overseas, puts a lot of strain on our services. So healthcare, education, and residential. So seeing housing sales pick up is good news. Now, the less good news are that when we look at business investment, it's been stagnant over the last few years. And in fact, after an encouraging second quarter in 2024, investment pulled back in the third quarter, and we believe that it will pull back even a little bit more in the fourth quarter. It's important to understand that despite the fact that interest rates are coming down, at 3%, we're still in a restrictive interest rate environment. So businesses hadn't quite found the right time to get back in with their investment projects. And this will be the major drag, again, on the Canadian economy this year. Because if we look at these companies' intentions to invest, we can see that they fell off quite significantly in early 2025. So what I'm showing you here is the Investment and Financing Outlook Survey that BDC conducts on a quarterly basis. We basically ask SMEs a bunch of questions. And one of those is, are you planning to invest in the next 12 months? And you can see that after hitting a recent peak in 2024, October, at 54%, it fell to 45% in January of 2025. So a big shift. And this is where we can really concretely see how the uncertainty is affecting Canadian businesses. So another component of GDP that I spoke about is exports. Obviously, the exports outlook remains very uncertain. Exports maintained a relatively high level over the last couple of years. And in 2024, it was backstopped by the fact that the Canadian dollar continued to weaken against the US dollar, which means that Canadian exports are cheaper in the US market and therefore more competitive. Obviously, with tariffs potentially incoming or broader tariffs than the ones already in place, this could suffer considerably in 2024. So we expect that should tariffs be in, this will certainly be a drag on the Canadian economy. So overall, when we put everything together, this is what we expect for the Canadian economy: an increase of 1.5%, modest growth, not quite potential, but still positive. And this will be driven by the Canadian consumer and in part also by the government that has plans to increase its spending this year. Obviously, like I mentioned before, should broad sweeping tariffs be imposed, all bets are off. We would have to revise our forecast, and we would likely find ourselves in a recessionary scenario. All right, let's look at Ontario. So the Ontarian economy slowed a lot in 2023, and then even further in 2024, registering an increase of only 1.2%. Now, there were a lot of factors that affected that weaker economic growth in Ontario. On the monetary policy side, the high interest rates were very hard for businesses, part one, but also for households, because households in Ontario are much more leveraged. They have a higher debt to income ratio than any other province outside of British Columbia. And Ontario and BC are relatively similar, and the other Canadian provinces are quite a bit lower, which means that the strain of the high interest rates hit those households a lot more. So it resulted in slower consumption because these people with debts were paying off their interest at a higher degree, slower real estate activity, and also slower manufacturing as investment was held back. Now, 2025 is looking different. So retail sales are picking up in Ontario because rate cuts have brought some much needed relief to those very leveraged households. So they have more money in their pockets at the end of the day than they did when interest rates or the policy rate was stuck at 5%. So this will encourage consumption. Disposable income has also risen quite well in Ontario. Like in Canada, wage growth has outpaced inflation. And this, again, enriches the Canadian or the Ontarian households. Home sales are also picking up. It's been a difficult last couple of years for home sales. And we've seen that in 2024, some significant progress there. A little bit of a pull down at the end of the period, but still, since the initial rate cut, activity in the housing market is improving. And again, that's a very important indicator for the Canadian economy. All right, uncertainty. So here's another question from our IFO survey. Whether you plan to invest or not, what could limit your investment? And obviously, uncertainty tops up our list of answers at nearly 40%. But there are other concerns as well. Interest rates are still not gone, even though they have come down. They still do limit a certain amount of economic activity. Low demand as well. High input costs have been a problem for a number of years. Input costs rose significantly during the pandemic and have not come down noticeably since. So if we look at what is going well for Ontario, the automotive sector has done very well over the last couple of years with significant new investments from big projects from companies across the globe. Now, this is obviously a very good thing. We've got the Honda EV, Volkswagen, Stellantis, et cetera. But of course, with the situation that we're facing now, with the US administration teasing a possible tariff on Canadian cars, these investments could see some headwinds. So this progress that we've seen before could be held back a little bit by this uncertainty. Government spending, I mentioned it earlier, is going to, or slated to continue to increase in 2024 and 2025, which means that it will support the Canadian economy alongside the consumer to bring growth to Ontario. So as things stand, we expect that Ontario GDP will increase by 1.5% this year. I will repeat the same caveat that I did for Canadian GDP. There are headwinds, especially the steel and aluminum sector is particularly strong in Ontario. And obviously, the Ontario is the province that has the strongest trade relation with the US. I'm sure that you have all seen the numerous tidbits that have been said in the media about Ontario being the largest trading partner of a significant amount of US states. This broad 25% tariffs would hurt Ontario more than any other Canadian province. So should we have to revise this number because of the imposition of those tariffs, obviously, we would imagine that Ontario's economic growth would slip into negative territory. So that's the economic side. Now I want to talk a little bit about managing through uncertain times. So this is a measure of economic uncertainty. And we can see that uncertainty is at its highest point since the onset of COVID. It's not much of a surprise given everything we hear in the news from the US administration, which recently has maybe stepped a little bit back from tariffs and has now focused on geopolitics. And that's not necessarily declining the amount of uncertainty in the world. So we're pretty sure that this uncertainty level is going to stick with us for a little bit of time. So what to do at this time? And again, this is the metaphor that Rishi shared with us earlier is fantastic because it's time to plan. It's time to ask for advice. So right now, the impacts of the tariffs haven't quite hit yet, and we don't necessarily know exactly what it's going to be yet, but it's time to be proactive. Get informed on the developments, look at your strategy, do an audit of your productivity within your company, find gaps, and see where you can improve. The second point I'll make is it's a good idea to de-risk your international activities, if at all possible. We're talking here about diversification, not only in your clients, but also in your suppliers, because your input costs may be affected by the imposition of tariffs. And when we're talking about diversity here, we're not only talking about international diversity, but also, or diversification, but also internal Canada. There's been a lot of talk recently about all of the intraprovincial trade barriers that exist in Canada, and the government is going to take a long, hard look at how they can make it easier for Canadians to trade amongst themselves. Right now, it is easier to buy a bottle of whiskey from Kentucky in Ontario than it is to buy a bottle of wine from the from BC, for example. Things like that will be talked about and negotiated. Now, hopefully, we can make some progress there, which will unlock more internal potential of the Canadian economy. Finally, enhance financial resilience. Strengthen your financial position. Look and talk to your banker about access to credit, other financial resources. Seek advice. BDC can help through our financing and advisory services. Something we hear a lot of talk about right now is operational efficiency, how to make your company as efficient as it can be in order to weather the storm. So I'll conclude with a few key messages, starting with the progress so far. We have achieved this famous soft landing, and that's not nothing. It's a very important development for the economy. Inflation is under control, and the monetary policy is being loosened, so that policy rate is coming down. Those lower interest rates are going to stimulate households to consume. It's going to stimulate the residential market, and we expect that those will drive a good portion of the GDP growth in 2025, which currently we have at 1.5%. In the case of Ontario, there are some significant headwinds that are brought about by this uncertainty. Ontario is very exposed to the US, but all things considered, as the situation stands right now, we expect a growth of 1.5% this year. But trade tensions with the US cloud this economic outlook, and they're probably not going away. The US, Canada, and Mexico are due to renegotiate their free trade agreement at the beginning of 2026. So until then, we can expect that there will be posturing and pushing around from the US administration in order to try to gain some sort of edge at that negotiation table. So 2025 will be a year where uncertainty is pervasive, I would say. Finally, there are things that you can do now for your business to make it as resilient as possible to weather this economic uncertainty that we are currently living. I really encourage you to reach out to your banker, to your network, attend events like these. Are very good to talk to other entrepreneurs. What's worked for you? How can I implement some of those policies? And seek advice from your friends, family, and network. So I'll leave it there. We're pretty much 30 minutes on the dot. And I'd be very, very happy to take any questions that you might have.
Arnaud, thank you so much. First of all, if anyone has questions, feel free to raise your virtual hand or drop it in the chat like Danny has. Arnaud, can't thank you enough. First of all, appreciate your comments on interprovincial trade. That's something Chambers of Commerce throughout the country, Ontario Chamber, Canadian Chamber has long advocated for it. So it's silly and embarrassing, frankly, about how hard it is to conduct interprovincial trade. And so we're glad that it's seeing some attention in this provincial election in Ontario and with the Council of Premiers. One thing I want to ask before we jump to the rest of the questions, we know that a lot of Trump's guidance on this has been from Richard Lighthizer, who seems to be solely focused on that trade surplus deficit with different countries. And what I haven't seen, and we know that when you net out oil, that the US actually has a trade surplus with Canada. That being said, have you seen, because I know I haven't to date, but a thorough economic analysis of what tariffs and the imposition of tariffs would be to the US economy and its people? Because I think we were all under the impression that the president believes that it's our government or our companies that cut a check, with tariffs, and it's not the importing companies. But have you seen that analysis yet that would really paint that negative picture to the US consumer?
Yeah, so there have been a number of analysis that's been done, but there's a lot of uncertainty around these analyses because the impact of the tariffs on the US population is likely to be inflationary, but the degree to which that is inflationary is difficult to measure. So the degree to which households will have to pay more for some goods is very, very difficult. If there is a 25% broad tariff, a lot of goods are going to go up in price, just simply definitionally speaking. And I think it's important to understand, and it goes back down to that supply and demand explanation that I did earlier, is that supply cannot react immediately. And in fact, it takes time. It doesn't take months or weeks, it takes years. So when the US administration talks about providing their own energy and weaning themselves off Canadian energy, unless those projects are near completion, that's not going to happen anytime soon. So that will undoubtedly mean that the US consumers will pay more at the pump. They'll pay more for whatever products are the downstream from that energy business. So it's that lack of ability to pivot quickly that really brings inflation about. Now, there are opinions as wide as any spectrum about how this will work. The administration places its hope that tariffs will serve as a tax that they will then collect and then redistribute in a certain way through less regulations, perhaps even subsidies, which the US administration spoke about just recently for the first time. So that impact overall will help certain portions of the American economy, but it's likely to continue to widen the income gap, which has already widened significantly in the US economy over the last couple of decades, because those who can invest will invest more, but those who are unable to invest their money in the stock market, do not have retirement savings, things like that, those people will unfortunately not be able to, because they're not going to increase the minimum wage. They're not really going to undertake policies that are going to help the lower income class. So should the US economy continue to float along, that income disparity gap, though, is a very worrying continuation, I would say.
Thank you. We'll go Danny and then Wasim. And Danny's question was around the Canadian outlook, and it not really mentioning the accumulation of debt in Canada, you know, at the Canadian level, the provincial levels. Can you comment on that as it relates to some of these concerns around stimulus that might be impacted by tariffs?
Yeah, of course. And, you know, rising debt levels have been a worry for a number of years. The budget deficit has ballooned, unfortunately, and it's definitely on the minds of all the provinces at this moment to get that into surplus, because continuing to indebt themselves, especially in this sort of environment, is difficult, and it obviously limits their ability to spend and to provide stimulus, but it's something which definitely needs to happen in in an acceptable horizon. The problem is that right now uncertainty and the potential fallout from the tariffs mean that businesses and consumers are going to need help. So unfortunately, now is not the time to tighten the belt per se. Now is the time to be, proactive and make sure that those businesses can continue to grow, because we do not want the destruction of economic activity in Canada, And something that I didn't mention in the presentation, but I should have, is that on the consumer side, the uncertainty really arises and becomes a lot more impactful when the labor markets start to slow. So as soon as layoffs start to happen because companies can no longer keep their employment levels because of the tariffs having an impact, that's when the consumer goes, oh boy, this is not good. I might lose my job. One person in my household might lose my job. I need to make sure that I'm prepared for this. So maybe I shouldn't buy, that big ticket item that I was planning. So that sort of behavior, or that sort of a trickle down, will be very, very important in determining economic strength this year. So all this to say that, while I'd say austerity is important, it's important to bring down that debt that has ballooned in the last couple of years. We also need to make sure that Canadian businesses get the support that they need to weather this storm.
Thank you. Wasim.
Yeah, thank you very much for a great presentation. Speaking about big ticket items, we are in the business of big ticket items, which is real estate. And my question is, first of all, how do you see this impacting the Canadian real estate market, or if we bring it down a bit more narrow in terms of the GTA market, in terms of prices, but also from the building and renovation side of things, because material cost is going to go up as well. So I'd just like to get some more insight, because if we're talking right now about, stimulus, and we're talking about right now sort of like COVID measures is what I'm hearing from, the provincial government, is they're getting ready for COVID-like measures to keep businesses afloat and keep people employed. We're getting into a situation of inflation. And people right now are a bit more optimistic that interest rates are coming down, so they're delaying their purchases because of that. But if inflation starts happening, one of the levers that the government has, or the Bank of Canada has, is interest rates. So can we just try to make sense of what's happening there, or what potentially can happen?
Yeah, I mean, for sure. And it's an excellent question, because I mentioned that input costs, materials had gone up a lot, and they came down a small amount, but they're still very high. They're way above if you look at, there's a measure called the IPPI, the Industrial Product Price Index. And if you look at how that's reacted during COVID, there was a huge spike because of all of the supply chain issues, and it kind of came down, but it's way above the pre-pandemic trend, let's say. So we know that high input costs are not going away, and those will only further be exacerbated by these tariffs. So obviously, inflation is likely to hit certain sectors. Now, whether it'll trickle down into consumer goods and the groceries, for example, that remains to be seen. As things stand, it's just the steel and aluminum products that will cause that inflationary effect. Again, if broad sweeping tariffs of 25% on both sides of the border get implied, that's all bets are off there. We're pivoting to an entirely new reality. So to answer your question, it's for sure that construction costs are going to increase. This will limit some of the construction activity. But I think that what's very important is that there still exists a lot of red tape regulations in place that stop the development of housing. And I say that over the last couple of years, those have been arguably, I don't want to say more impactful than the rising input costs, but they have held back a lot of investment. And governments, provincial governments have all made a commitment to be able to cut that red tape because we need to put more housing for Canadians. We know that rents are rising and that more and more people are coming to Canada. Now, what I will say is about the residential market is that because we are capping that temporary foreign immigration, that'll also give a little bit of breathing room to the residential markets to say, okay, we don't necessarily need to build as quickly in order to, to stimulate this. So it's important that there is a recovery, but that weaker population growth will help in a certain sense of the way. So for sure, importing inflation is not something that we want to do, but we don't really have a choice. Some of those steel and aluminum products that we buy from the US are not replaceable, and we're going to have to do it. So it will likely trickle down into the price of construction, into the wages of construction workers. And activity, I think, will be such that we could see a labor shortage, a continued and even intensification of a labor shortage of those workers in the construction industry, so those trades, et cetera, which are absolutely crucial. So all in all, I'd say that the outlook for the residential market is still positive. The impact of the tariffs as is will likely put further increase pressure in prices, but interest rates are coming down. So new entrants into the real estate market are going to be favored. And it's actually a good time because investing in real estate is known to be a safe investment. Over a number of years, you're pretty sure you're going to get your money back. So right now, in a time of uncertainty, should you invest in something, investing in a building is a pretty good investment. So parking your cash there at now more favorable interest rates than they were a number of months ago is something which I think we'll see more and more people do, especially as the policy rate continues to come down later on in the year. So in a couple months' time, I think we're likely to see another interest rate cut, and that will further lean, more pressure into, or more buying power into the hands of those consumers looking to buy a home.
Arnaud, what Leslie asked, in light of the tariffs, and I know they're a bit of a moving target as of late, but are there emerging industries or sectors that offer the greatest growth potential for Canada and trying to find a positive on this?
Yeah, I mean, look, in every situation, there are opportunities, right? And maybe one of the ones that I think personally has the best chance is the tourism industry. So our Canadian dollar has lost a lot of value against the US dollar, not quite because of the uncertainty. It has reacted in January because of those announcements, but simply because there's a policy rate difference between interest rates in the US and interest rates in Canada. And here's another Econ 101 capsule, is that we have this mechanism where foreign investors will seek two things generally when they try to figure out where they want to place their money. First of all, it's stability. And the second of all is interest rates. So if there's a gap between the interest rate in the US and Canada, more capital will flow into the US. This means that people buy up US dollars, they become more scarce, and the value of the Canadian dollar depreciates versus the US dollar. So simply because of that interest rate gap, the Canadian dollar has lost in value. But that means that for foreigners coming to Canada, it's actually great value for money. And because the Canadian dollar is losing value to the US dollar, it also means that Canadian tourists are less likely to go to the US because it's more expensive for them. Also, the social movements that have been happening right now with the Buy Canada, I'm sure many of you watched the hockey this weekend, and we're no strangers to the sounds. I think Canadians will look inside their country. And I think tourism, it's a good time to travel within Canada. So that is one industry that I think could benefit from the depreciation of the currency. But there are others as well. Export markets, there are some that are very, very reliant on the US, and a weaker Canadian dollar means that they have wiggle room. They have that room to negotiate with their American clients and in order to make a deal. So I think that despite these tariffs, trade is not going to stop. Trade with the US will never stop. There are certain supply chains which are absolutely integrated. They will change in a certain sort of way, but there are definitely opportunities within this situation.
Arnaud, one of the things sometimes we see when there's been economic uncertainty going back historically is that a lot of organizations will say cut marketing spending and things like that, and we're usually ones to advocate, that's actually the time you need to be spending to make sure you don't lose that kind of pipeline, that customer pipeline, et cetera. Thoughts on that for some of our businesses here that are wrestling with, with this uncertainty, and and how that relates to their marketing and how they should be looking at things going forward.
Yeah, I think that's a great question, because I could say as a blanket statement, it's a mistake to cut into marketing, because that's how you get new clients, that's how you increase your exposure. But it's certain that in these types of scenarios, just as I said, you have to perform an internal audit of your processes. And it's really not a surprise that a lot of people say, well, maybe I should scale back a little bit on marketing and focus more on, making sure that my business can continue to operate. So I definitely understand both sides of the argument, but I think that it's still very important to be out there, pushing your product, trying to reach new clients, and trying to expand your markets, to diversify your markets, as I said during my presentation. Here, I would encourage people to be very involved in your marketing campaigns. Bring up performance metrics. Figure out how good are my marketing campaigns actually doing. Don't just assume that because you launch a big marketing campaign that it's going to lead to big results. Assure yourself that they will. So, be on the ball, make sure you follow these processes. If you have somebody in charge of marketing, ask them, how do you think these have performed? Really get into it to figure out what's the best value for money at this moment. So I would say it's unlikely that no one will pull back on those budgets, but it's very important to continue to put yourself out there and to try to grow your markets during these uncertain periods.
Well, listen, Arnaud, we can't thank you enough for this presentation. Frankly, I think this has been one of the best ones I've seen, both in the detail, the focus on the uncertainty that we face, but your way of kind of bringing it together to some tangible data points that really help explain our current situation and bringing reality to the equation. And that's one thing I think we've been struggling with in the last while is it's the unpredictability, and I'll not use the person's name, but that has made a lot of this frustrating, is because it doesn't seem to be data driven or metrics driven. It seems to be more emotional. But your ability to share the data around this and how it's impacting Canada and Ontario is greatly appreciated. So thank you very much. And just so I remind everyone, we'll be sharing this recording, but we'll also, Arnaud has agreed to share his presentation with this group. And so Arnaud, to you and to Rishi as well with the BDC, thank you so much. This is a lot of businesses, it's keeping them up at night, business leaders here. And having some information, even that little bit, just helps, I think, create some reassurance going forward and in very uncertain times. So thank you very much for this.
You're very welcome. And, BDC is here to help. Don't hesitate to reach out to us through multiple channels. We'll do what we can to give you guys a hand in that.
Absolutely. And at the end, I just wanted to also, float this around. Just take the advantage of bdc.ca has a lot of resources that you can take advantage of, whether it's like, current tariff situations and things, and which products are going to be affected by the tariffs. So I would encourage you guys to visit that, and you can subscribe to our monthly economic, letters too. So please take advantage of that as well. So thank you again.
Agreed. Rishi, as you know, we often steal that info and share it on our website because it's so helpful. But again, thank you again, Arnaud and Rishi, and to everyone for joining. Thank you, and have a great week.
Have a great day, everyone. Stay warm.
Bye-bye.
Yes.
Bye.
Thank you.